Hey everyone, this is Dylan Marma, founder of the Requity Group, and in this video, I'm going to provide you with a comprehensive overview on the Requity Income Fund, why real estate private credit, why with us, how the fund works, and we look forward to partnering with many of you on this venture together. The objective of the Requity Income Fund is to invest into a diverse mix of real estate-backed first position bridge loans, leveraging our operations experience. We're underwriting conservatively and undergoing thoughtful deal selection. So the way this all came together is as we founded TRG back in 2020 and started focusing on income generating equity real estate investments. And about 3 years ago, I started to invest personal capital in between deals into private real estate loans, and I thought it was a great way to be able to generate consistent cash flow. And then about 2 years ago, under the Recquity Group, we started to originate loans and do loans both with our investor capital and our personal capital. And over the last 2 years, we've realized that there's a lot of demand for this type of investment. And particularly in this environment, we think that it's a great opportunity to be able to get solid double-digit returns backed by first position liens on real estate. So we're going to dive into this, but as far as the fund goes, it's a real estate direct lending fund. It's secured by real estate loans. The fund term is evergreen, meaning that this is a long-term fund. We have a target fund size of 20 million, but we anticipate that could continue to grow over time. However, we are focusing on this in a crawl, walk, run format with initially targeting about 2 million of total commitments to be able to call down on. And over time, the fund will be able to grow into our long-term goals. The distribution frequency is monthly. As all of our other investments, our investors enjoy monthly distributions. We have a 90-day redemption period, which means that after the first 12 months, there is 90-day liquidity. So if you put in a liquidity request, we're going to work to be able to get you your initial capital back, and you can cash out of the fund and then come back in when you choose to. It's a 506C, meaning that this is for accredited investors only. Our reporting is quarterly, as is with the rest of our investments. Again, the target initial fund size is 20 million. However, we're initially targeting the first benchmark of 2 million on this call. The minimum investment is $100,000. We are investing at least 5% of the total amount. In the beginning, it will be much larger than 5%. And we are investing in a first loss position. So for those that have been following along with Recquity lending, you'll notice that every single deal we've done, we've typically been at least 10% of the total loan amount, and we've typically put our money at risk first before our investors. So we do this to show our conviction in the loans that we're financing and to essentially just align interests and show that, when we invest into any loan, you first have the borrower's the deal's initial equity, the borrower's equity at risk, followed by the borrower's assets, followed by our investment, and then very at the bottom of the capital stack is the investor's first position loan. So if you look at that and look at where you are positioned in the capital stack, you'll see that we really do our best here to minimize downside, and by putting our money in a first loss position, hopefully that communicates the conviction that we have behind these investments. This is a 10% preferred return, and we anticipate the preferred return to be paid out each year. So if you invest $100,000, that's about $8,300 per month. The fund has zero management fee. So the way that we get paid as managers is initially all the capital flows into the fund first, then the investors get paid, and then only after that does the manager get paid. So if we perform at, call it a 12 or 13% return at the fund level, the investors are getting the first 10%, and then the manager is getting that additional 2 to 3% on top of that. But essentially, we are eating last as managers, and to even further align interests and show this is a steady, high yield investment opportunity for our investors. The fund level leverage is 0%, so that means that starting off, we're going to have no leverage at the fund level, meaning we are first position liens. All of the returns are generated buy the deals themselves. And if we're earning 10%, we're lending at least usually 12% plus to be able to hit that kind of return. And I would caveat that at some point in the future, we may have fund level leverage because as we're offering liquidity, we may want to get a line of credit at the fund level to be able to pull on, to be able to cash investors out faster when they put in a request for their capital back. But if we do begin to take on leverage at any point in the future, we will communicate well in advance. And the reason behind it is for liquidity purposes, to be able to allow us to have even faster liquidity for our investors, not because we're sitting here to juice returns at the fund level and just shoot for the maximum target return, right? The way we've structured the fund, our interests are to be able to get steady, consistent returns over time. So, and that's why we've decided to go with the fixed return model, because we don't want to swing for the fences. We want to get steady singles and doubles and continue to pay out that steady 10% to investors over time. As far as service providers go, we have our fund admin, NAV Consulting. We've been with them since early on the very first fund, so many of our investors are familiar with them. But this is a third-party organization that manages billions of dollars of investor capital and provides that additional security to have that third party in place to be able to calculate the distributions, be able to review the subscription docs, and be able to ensure that the investor funds are tying as they should be according to the subscription and the private placement. Our fund counsel, the Ravella's Law Group, we've been with Simon Ravella's for the last 4 or 5 years now, and they've been great to us, and they've put all the docs together. Our lender counsel is Private Lender Law. We believe they're the best in the business. They are a New York-based law firm that specifically focuses on private loans and bridge loans. They do over 1,000 transactions a month in both the residential and the commercial world, and they've been excellent counsel because we are investing into a financial instrument, which is a loan, so having the right counsel behind us is very important. And the bank is Five Star Bank. We have many accounts with them, and they've been a great bank and very good service. Now, in terms of tax advantages, we know that our investors are oftentimes looking for strategic ways to be able to defer taxes, offset taxes, et cetera. And with investing into debt, it's not inherently a tax advantaged asset class. However, there are some strategic ways that you can enable yourself to be able to defer taxes to enhance the compounding of investing into a vehicle like this over time. So many investors will choose to participate using self-directed IRAs, solo 401ks, or HSAs. This allows you to invest through these vehicles and defer taxes to just better compound your wealth. And when it comes to these accounts, we do have some people in our network that we're happy to refer you to, so you can consult and determine what's the best way for you to invest in the fund. What is real estate private credit? So there's been a lot of buzz around private credit. I think ever since rates started going up and banks started pulling back, a lot of people have moved towards private credit, and it's a very broad industry. It has its position for a lot of growth over the next decade. Tons of people projecting that it's going to double in size. But essentially, real estate private credit is non-bank lending, business purpose non-bank lending on real estate assets. And that means that we're putting, we call it private money loans, hard money loans. We are going with bridge loans, which are short-term loans that do not necessarily have the requirements of traditional banks. And we're going to cover a few reasons why there's a huge need for this in today's market. The key characteristics of bridge loans, private credit loans, are we have speed to close, which is the fact that we're funding in as little as 7 to 14 days. We've closed in even less than 7 days on some circumstances, although typically, I'd say our average deal has a little bit more runway and will take a few weeks to close. That is far faster than traditional lenders, which can take 50 to 60 days. This gives buyers the ability to get better pricing, get better terms, because they're essentially competing as cash buyers. Or maybe their initial loan fell out and they need something that allows them to actually get the deal across the line at the contracted price, right? That's where we come in, and a lot of times we can get really good terms because we have the ability to close quickly. We have a short-term structure. So loans terms are typically ranged between 12 and 24 months, which is perfect for projects with fast turnaround strategies. Also, as investors, this is really attractive because if you look at the risk on a loan, if you looked at a 10-year loan, it's sort of a bell curve where as you get into years 3 and 4, the risk initially goes up and then it begins to go down. But when you look at the first 12 to 24 months, it is one of the most secure points in time when it comes to the risk of the loan, given not much has changed with the borrower or the asset in the first 12 to 24 months. In addition to that, you know that you're still relevant in the marketplace because you're pricing according to today's market, and that's only going to change so much in 12 to 24 months, giving us the ability to stay at competitive pricing in whichever market we enter. We have flexible asset-based underwriting. This means that we are not just looking at the credit score and tax returns and having an algorithm determine what we can offer. We are looking at the value of the collateral. We're looking at the borrower, their liquidity, their investment experience, which allows us to be more strategic with how we price. High interest, modest leverage. So it's important to note that just because our interest rates are higher, right, and we're charging 12% when a bank might offer, call it 7, doesn't mean that we're doing crazy amounts of leverage that banks wouldn't offer. Most of our loans are equal or less than what the banks would offer on leverage once the asset is stabilized. The big difference is that we're often underwriting based on the as improved value, and then we're funding either the initial property up to a certain percentage of the purchase price, and often some construction or capex that's getting done to the property, and then feeling really comfortable that we're insulated based on the future value of the property at that point in time. So just because it's higher interest doesn't mean that it's higher leverage. It's more that we're taking on deals that might have a little bit of hair, or they just don't quite fit the mold, or they need to close quickly. So it makes more sense for people to go with us. And we'll show you an example of that in a bit here. First position and personal guarantees. So these are all first position loans, again, the safest place in the capital stack. And not only is the asset our collateral, but we also have personal guarantees. We always ensure that the borrowers have ample liquidity and net worth to be able to fund the deal and keep the deal alive if anything goes south, in addition to make us whole on our loan amount. Then we have interest only with balloon payments. Typically every loan is interest only, and then at the end of the loan period, they will either pursue a sale or refinance to pay us off in a balloon payment. Why real estate private credit? Real estate private credit makes sense because we have one consistent monthly income. A lot of us are seeking attractive ways to diversify our portfolio and not be at the whim of the ebbs and flows of the stock market. And when you look at real estate private credit, in my view, it is one of the least volatile places to invest, as long as you are making thoughtful, strategic decisions on which deals you're going to fund and how you're going to fund them. So that consistent monthly income, we want this to be income that someone can count on to see month over month, and give them a good way to be able to diversify their portfolio with a strong income investment. We also like real estate, particularly when it comes to private credit, because real estate is a hard asset. Right? There's a lot of private credit funds out there that focus on high net worth investors that are business private credit, and they're giving loans to these businesses of different sizes, and business is so much different in the sense that business can go to zero much easier than real estate can. Right? If you're at 50% leverage on a real estate deal, you can feel really good sleeping at night, because it's hard for most forms of real estate to go down 50% in value, especially in 12 to 24 months. A business going down 50% in value in 12 to 24 months, it happens all the time. So that's why we really like real estate, particularly when it comes to a private credit fund. And we've structured the fund to be competitive with very similar returns and equal returns to many of the popular business credit funds that are out there. We have significant collateral and downside protection, again, because we have hard assets and real estate as the main asset. We're in first lien position, and we have the borrower's personal guarantee. And we have high demand and limited supply. This is something that stands out to me and is a big part of our thesis on any investment that we make. when you're looking at investing into any asset, no asset is good at any price, right? And it's very few assets are bad at any price. So it really comes down to having pricing power is such an important part of your decision. When you look at the real estate private credit landscape, what you see is there's a big gap. On the $5 million plus loan amount, you have a lot of large, $1 billion plus assets under management companies that are targeting bridge loans and different forms of loans to be able to get deals that might not fit the traditional bank mold across the line. When you look at the small side of things, you have a lot of your average your neighborhood RIA attendee lending private money out, in addition to actually institutional capital beginning to flow into what now is becoming not just a fix and flip loan, but an RTL, residential transition loan, is becoming an institutional asset class that is actually getting collateralized and rolled up into a CMBS that's then sold off to the broader market. So you're seeing more competition coming in and pricing getting more aggressive and leverage getting more aggressive. But on the small commercial side, anything less than $5 million in loan amount, which is a tremendous amount of opportunity out there, it is a blue ocean. There's a wide open landscape of people that don't either don't have the background to understand how to price these commercial assets, or they're just too big of funds to be able to justify going after these smaller commercial assets. So we really see a lot of pricing power, the ability to give fairly low leverage loans and still get really attractive returns. And there's bigger demand than ever as we're seeing banks pulling back on investing into these assets. So that's where we really see the most opportunity. And what we love about those assets too is they're cash flowing assets, right? So when you're investing into just a fix and flip loan, the loan is getting serviced by the borrower just coming out of pocket each month, and it's all dependent on how much cash the borrower either earns at their job or has in their bank account. When you're servicing commercial assets, you're able to get deals that already service themselves, and the deal itself is paying for the loan, which gives us even an additional layer of insulation. So we are still funding residential loans, and yet we are not usually competing with the institutional lenders. We're usually more coming in and lending on the deals that need to close quickly, or they have some kind of hair on it that makes it not a fit, or maybe the borrowers are just tired of working with institutional lenders because they're talking to too many committees and they have too many layers and they can't get a straight answer and they can't count on them to close, so they come to us instead. So we are still working on residential loans. That will be a decent portion of our fund investment strategy. However, we do see a lot of opportunity in that small balance commercial space as well. And why with us? Because I think investing with Recquity makes sense in this asset class because we have proven experience as operators. We currently operate over $100 million in real estate. I've been involved as principal in over $200 million in total transactions. On the principal side, we've never lost money for investors. We generate consistent returns with high yield. We have 70 plus team members. We've gotten a really strong base of investors that have been very loyal to us because of the way we've been able to perform over time. We have first loss position. So we are putting our money where our mouth is, and we're putting our capital at risk before your capital is at risk, showing even higher conviction on the strategy. And we are entrepreneurial. When you look at what we've been able to accomplish, we've worked in many different markets, we've worked in different asset classes, and we've been able to land on our feet and perform. And that's because we have a team, and our leadership team is a nimble team that's able to move fast and get things done. And a lot of times being nimble like we are has allowed us to win deals that the institutional investors wanted and win them even better prices in many times because we don't have the same layers of red tape that they have to go through. And we believe this applies equally, if not even more, on the lending side of things. Our lending criteria. When it comes to collateral, we lend on both residential and often small balance commercial properties, securing a first lien position on each. When it comes to leverage, we target 65% of the after repair value, or for commercial, call it the stabilized value of the asset, or up to 80% of loan to cost, which is either the purchase price, often the purchase price plus the initial capex. And we use these to balance each other out because we don't want to go lend at 100% of the purchase price just because it's at the right price. We want to make sure that the borrowers always have ample skin in the game. Borrower fees, often on the way in or origination, we have 1 to 3 points, and then we also We'll commonly charge exit fees, which means after the loan, as the loan's getting paid off, we have 1 to 3 points. Again, it's not really a prepayment penalty because it's just a fixed return that comes on the back end of the loan. The loan term is 12 to 24 months. Our typical loans are 12 months. We sometimes will add in a 12-month extension where we see best fit, where they can pay sometimes an extra point, 1% of the loan balance, to be able to extend for an additional 12 months. And we always have 3 months of minimum interest-only payments on all loans, meaning that if it is a quick business plan strategy and they get in and get out in 2 months, they still owe us 3 months of interest payments for the loan. Our interest rates, 10 to 14%. Almost all of our loans are currently 12%. Our geographies, nationwide, Southeast, and lender and landlord friendly markets are strongly preferred. So we are lending in the areas that we would invest into, and in the areas that we maybe are not as bullish on investing into, we may still lend, but we may do it at lower leverage and discount accordingly. As far as legal protections go, we have personal guarantees, cross-collateral, escrows, and again, the asset itself. And asset classes, we are targeting at least 50% of the fund to be deployed in the living sector, as this is a sector that we know best, we have the most experience in, and we believe that the shortage of housing is going to be one of the biggest challenges that the country faces over the next 10 plus years. So we feel like this is a strong backbone for the fund to have at least half of the assets invested into. And this includes mobile home communities, residential units, 1 to 4 units, multifamily, and long-term RV. We will consider other asset classes, but we will likely be lower leverage, and we are committed to keeping at least 50% of the total fund invested in the living sector. Risks and mitigants. So along with any investment opportunity, you do have risks that come along with it. When it comes to this investment fund, we see 3 key risks. We see market volatility risk, the risk that the market goes up and down. And of course, in our case, we're trying to protect our downside from downward market swings. And the way we protect against this comes down to a few different points. One, we have our geographic and asset diversification. So it's not like we're invested into just single family flips in just one market, right? And if that market sees a big swing and prices all drop 10%, then all of our borrowers are struggling to get their equity out and maybe our loan amount becomes at risk. By being in different markets, we're getting exposure to different ups and downs, because real estate is not just it's not just one real estate cycle. Every market has its own cycle that it's facing. And then by having different types of assets invested, we are also seeing that there are different cycles per different asset classes. Just as right now you see some asset classes are thriving, whereas other ones are having a very tough time. We also like, again, to emphasize that by having asset diversification, a lot of our assets are cash flowing, right? That's probably one of the big things that will stand out different with us versus a lot of, more of your traditional kind of like fix and flip funds, is that we're not just relying on the borrowers to keep coming out of pocket for their payments every month, but we are investing into bridge loans that are supported by the assets themselves that are cash flowing, giving us, ability to further reduce our risk. We have conservative underwriting. Of course, we're looking at every deal from the lens of an operator and feeling where would we be comfortable owning this asset and what gives us that margin of safety that we're looking for. And then we have exit flexibility. Of course, when we look at every deal, we're determining, is this going to be a refi or a sale? Can it both refinance and sell? And we feel comfortable having multiple exit strategies. The second big risk is execution risk. This is the risk that the borrower doesn't execute on their business plan. Maybe it's because they have cost overruns. Maybe it's because labor goes up. Maybe it's because they have life events take place that throw them off course. It is a real thing in any investment deal. There's always execution risk being one of the number one risks that take shape. In general, by focusing on the living strategies that we have, we do feel like it reduces our risk inherently a little bit, because these are not the most difficult to execute business plans more often than not. There are also business plans that can often be executed by third-party managers, but going further into it, we do mitigate against the execution risk with a few other levers. We have our construction draws. So we don't just go ahead and write the borrower a check for $1 million cash out and with the promise that they're going to go execute on their construction plan and put a new roof in and things along those lines. We have the borrower submit a scope of work, and then we will have them draw down over time on the improvement funds. So they'll submit to us pictures, and usually we'll have an inspector even go out and physically inspect the property before we will fund the draws for construction. We have liquidity verification. We always make sure that the borrower has adequate reserves to be able to handle any cost overruns. And then just ongoing oversight and communication with the borrower. The third risk is default risk. Default risk is the risk that, again, the borrower defaults. I mean, this is the primary risk, and the other two risks are really just things that will lead up to default. But default is essentially the borrower can't make their payments and the loan defaults. So the default risk we hedge against by doing very thorough underwriting on the borrower. We do credit checks, we do background checks. We're looking at their track record. We're sometimes doing reference checks, getting a real feel for who it is that we're lending to, what their experience is, why we believe that they're going to be able to accomplish what they're saying they're going to accomplish. We make sure they're in a financial position to be able to support the loan, to be able to give the project the funds that it needs, and things along those lines. And then, of course, lastly, we have that senior secured position to fall back on. It's never, we're not a, call it loan-to-own type lender. We're here to be able to support our borrowers to create success and sharing that success with them. But of course, we need to protect ourselves. So we do have, of course, the personal guarantee. And then lastly, that senior secured position, giving us the ability that in the downside event, we can go in and take on the asset. A little bit about Recquity. Recquity is a vertically integrated private equity firm focusing on high yield investments within niche real estate asset classes. Today we stand at 32 properties, over 2,800 units, over 70 team members, and over 140 million in assets under management. We've been going since 2020, and we've built up a really strong leadership team, really strong investor base that we're excited to be able to partner with on this. But the main point here is that we're not new to operating real estate. A lot of banks, a lot of lenders, they don't want anything to do with the operations. We live in the operations. We enjoy the operations. We're ready to roll up our sleeves if we ever need to, which should give you that comfort that if the asset ever falls into our hands, that we're ready to take it on and do what we need to do to ensure investor success. Recquity Lending originated its first loan in early 2023. And we've been focused ever since on the small balance in commercial and residential bridge loans. Today we've originated 30 loans, originated and serviced, total of 11.3 million in total originations. We've paid off 7.2 million, and we've had zero missed payments and a 0% default rate because of the thoughtful deal selection and partnering with the right borrowers. We've had a very successful run thus far, and we anticipate to be able to keep that going. And if we do have defaults at any point in time, we expect very, very low single-digit defaults, and we are projecting the fund to be able to absorb those, and again putting ample reserves in place to be able to handle if there is a missed payment or a default along the way. But we are definitely doing everything we can to be able to protect against that, but also absorb it if and when something does come up. As far as loans by asset type, you can see here 41% of our loans thus far have been single-family residential fix and flips. We have 35% manufactured housing communities, 13% RV campgrounds, and 11% multifamily loans. And that gives you kind of a picture of what we're likely to see, I would say, on the next few years of the fund's evolution in terms of our target asset classes. Now here are the initial fund investments. These are the seed investments that are going into the fund. We have a total of 7 assets, 5 of which are already existing loans that we're holding on our balance sheet, that we're going to start off. They're performing loans, they're in good shape, and these will be the seed investments for the fund. So the first 5 are different deals. You can see we have 1 mobile home community and 4 single family properties, making up smaller loans, all between the 100 and 200,000, and all maturing in 2026 with a 12% interest rate. And then we have 2 mobile home communities that are upcoming, one for 700,000, one for 800,000, with similar terms, that will be the first larger investments into the fund. I want to share with you the first of the mobile home communities. This one's a little bit further along in our diligence process, and we feel is likely to close here shortly. And this will give you kind of a sample deal just to give you an idea of what our loans look like and why people use us for these loans and the role we play in the broader real estate ecosystem here. So this is a 35-lot manufactured housing community. It's in Idalou, Texas, which is in it's a submarket of Lubbock, Texas. Good, decent, size MSA. We have 35 lots. What I love about this deal is out of the 35 lots, we have 33 tenant-owned homes. The average tenant in a tenant-owned home will stay for 15 to 20 years. It's about as reliable of any form of income that I've seen when it comes to real estate investing. In addition to that, they have one occupied RV space and one vacant RV space. So, strong, steady cash flow is what I would anticipate from a deal like this. It's on a well system with public sewer. It's got an NOI of $78,000. Net operating income and a loan amount of $700,000. So that means that gives us what at the bottom we have a debt yield of 11.1. That means you take the NOI and you divide it by the loan amount. That means that your debt yield is 11.1. In other words, if we were to buy this deal at the amount of our loan, we'd be at an 11.1% cap rate, which would mean we have a lot of built-in equity, as this deal would probably sell at a 7 to 8% cap rate. So it gives us a really comfortable spot where we have a lot of cushion, and we view the LTV on this. We actually got a broker opinion of value. It says 75%, but it's actually closer to 70, 71% on the BOV we just received back, which puts us in a really healthy spot here. And the idea is that this loan, they've done a lot of good. They've made a lot of good progress on this loan thus far, on this deal thus far. They've owned it for 2 years. It was initially bought with seller financing. The $600,000 seller note is maturing this year. So this loan is there to be able to first pay off the seller note and then to fund a 4-lot expansion. So since they initially bought the property, they've done a great job operating it. They've brought lot rents from $180 up to $295. They've increased the occupancy, and they have a scheduled $15 to $25 bump at the end of this year, in addition to at the end of next year, to be able to get up to what they consider to be the market rent. So we can just look at the previous 2 years of P&Ls and see that the operator is definitely being attentive. They definitely are. They know what they're doing. And when it comes to the loan proceeds, it's mostly to pay off that seller note, but it's also to give them some additional cash to be able to fund this 4-lot expansion so that they can finish finalizing utility connections. And then they're going to use 21st Mortgage to be able to finance new homes to bring in and either sell via cash sales or rent to own. And that's going to increase the property value. So at the end of these 12 months, they'll either look at selling the asset or they'll look at refinancing the asset, depending on what makes the most sense for them and their investors at that point in time. Borrower is very experienced. They got over 10 years of real estate experience, over 5 years of MHC experience. They operate over a dozen MHC properties, so they know the asset class very well. They got a good team in place, and that's apparent just based on their financials and the way that they've been able to operate this asset thus far. So we feel very comfortable with the borrower and their team. Lastly, next steps on investing into the Requity Income Fund. You can go to therequitygroup.com, and on there you can either log into the investor portal. If you're not on the portal, you can always message us or opt in there, and we can set up a call just to make sure you're familiar with us. We're familiar with you. We always like to have a pre-existing relationship before you join. And then at that point, once you're in the portal, you can review all the investor deliverables. We have the deck available for download, the limited partnership agreement, the PPM, which essentially the LPA covers how this deal is structured. The PPM outlines all the key risks, and then the subscription agreement, lastly, is to be able to confirm that you've read and reviewed and you understand the risks involved with the investment. Then at that point, you can go ahead and wire funds, which we will submit through either the secured portal. We always recommend you to call to confirm the wire information, and you'll get a draw request from the fund administrator with the total amount that we need you to initially wire, depending on your commitment amount, which we are aiming to have you invest your entire commitment amount day one, because this is a fund where we're going to be growing it gradually over time. So you have to remember that we're going to basically fund a certain amount to be able to fund our first chunk of deals, and then gradually we'll bring on more investors and grow it over time. But our goal here is to get roughly about the first $2 million or so of investor commitments in place so that we can draw down that first $2 million, put that money to work, and then we will announce when we're ready to bring on additional commitments and draw down from additional commitments that are in place. And then lastly, collect distributions. At the end of the first full month of performance, the fund admin will set up payments and will send out monthly distributions. We typically target by the 5th of the month, and those will be sent via ACH to your bank account, and we will be paying out distributions monthly. Down at the bottom, you have my contact information, my cell phone, my email, in addition to Lewis, who runs our investor relations, his cell phone, his email. Feel free to reach out anytime with any questions. Happy to schedule a call with anyone to answer any questions, and we look forward to partnering with many of you on this investment opportunity.